Hello, welcome everyone. Thank you for joining us again for our Wednesday workshop with New View. Today we will be discussing the state of the market, specifically on multifamily real estate. I'm a fan of multifamily, and our guest speaker will be Tom Carroll. He is the CEO of Ballast Rock. I would definitely Google that company. It's a great company. They got a lot going on, and he's going to give us some great updates on the state of the market. Before we get started, just a disclaimer, Newview does not provide tax or legal or investment advice. We are not CPAs. We are not attorneys. We're simply a custodian for self-directed IRAs. And what does that mean? So a self-directed IRA gives you the ability to choose your investments, whether that be something alternative in real estate, cryptocurrency, startup companies, anything like that. And I'll cover a few more in a few minutes, but it gives you the ability to take control of your investment. You don't have to work with an advisor that's going to pick and choose stocks for you. You can invest in things that are brick and mortar. And it gives you the opportunity to diversify your portfolio. What I tell my clients is you don't want to put all your eggs in one basket. The more diversification you have in your retirement portfolio, the better chance of having success when you retire. And everyone wants to retire wealthy, of course. You worked your whole life and worked hard for that money, so why not invest it right and then be able to enjoy that retirement? Not only that, you get a tax savings. If you're using a traditional IRA or a Roth IRA, they're just going to be taxed different, but it's either going to be tax-free or tax-deferred. You're also investing in what you know best. You might already be making these types of investments, and you just didn't know you can do it in an IRA. So these are the plans you can use to self-direct. You have your traditional and your Roth IRA. They're just taxed differently, but the contributions are the same. So you can contribute $6,000 a year to each one of those. And there's a $1,000 catch-up contribution if you are over the age of 50. So the way the traditional IRA is taxed, it's tax deferred, which means you don't pay taxes until you take distributions after the age of 59 and a half years old. you're taxed based on whatever your tax bracket is at the time you take the distribution. With the Roth IRA, it's the opposite. You pay the taxes when you make those contributions, so you're paying the taxes now, and it's tax exempt. And when you take it out after the age 59 and a half years old, you take it out tax free because you've already paid the taxes on those contributions, and there's no capital gains tax. So that's the best part about using a Roth IRA. Then you have employer plans, your solo 401k, a pretty popular plan if you're self-employed, or if you're investing in things like syndications or anything involved with leverage, and you're qualified for this plan. This is a superior plan because it's exempt from the UDFI tax. You can contribute up to $61,000 a year, and you're contributing as the employee and the employer because you are self-employed. With this plan, you cannot have any common employees. And the best thing is if you're over the age of 50, you can contribute an additional $6,500. So that's a big chunk of change to get you started if you haven't started saving for retirement. Then you have your SEP IRA. This one you can have employees, but there is an employee match. Same thing, it's up to $61,000 a year you can contribute. Now, this is based on your earnings throughout the year. Up to 25% can be matched and then contributed to that SEP IRA. Just cannot exceed that $61,000 contribution limit. And then you have your simple IRA. This is what I've seen used in small businesses. If you have like 3, 4, or 5 employees, there's a mandatory 3% match. You can contribute up to $14,000 a year. And if you're over the age of 50, an additional $3,000. And then some other plans that people don't know can be self-directed. You have your education savings account. So if you're saving for your kids or grandkids' college, this is a great way to do it. And you can partner this type of account with your IRA investments. You can contribute up to $2,000 a year. It is not tax deductible going in, but it does grow tax-free and can be taken out tax-free for any school expenses, whether that be tuition, books, laptops, anything like that, it can be used for. And then you have a health savings account. In order to be eligible for a health savings account, you must have a high deductible healthcare plan. So if your plan only covers you, then you can contribute $3,650 a year. If your plan is a family plan, then it's $7,300 a year. And there's $1,000 catch-up contribution if you're over the age of 55. Same thing, it's not a whole lot you can contribute, but you can partner that with some of the other investments that you're making, and then all your accounts will be growing simultaneously. All right, so these are the most common type of investments clients will be making. We see clients mostly investing in things like real estate. Now, real estate, it could be a rental property, an Airbnb. You could buy tax liens, foreclosures. I also see clients doing private lending, so secured or unsecured notes. And then most common, I think, next to real estate would be our private entities. Private entities could be an LLC, a startup company, a joint venture, a trust. Any structured investment where you're actually investing in the company itself would fall under private entities or private equities. And typically you'll have shares or units in that company by making that investment. And then the next thing we've been seeing, it's like one of those trends that's up and down. It's kind of similar to the stock market, would be cryptocurrency. Always do your due diligence before you make any investments. But these are probably the top 4 most common types of investments we see clients making. All right, so I'm real excited to bring Tom Carroll on. He is a Floridian right here in Boca, great guy. He is the CEO of Ballast Rock. I had the pleasure of meeting him. We really hit it off. He's got some great information, some tips on the market and things to be looking out for. Tom, how's it going?
Excellent. Thank you, Brian. How are you?
I'm doing well. Thank you so much for joining us. I'm going to let you take it away, and I will meet you at the end for Q&A. And it looks like your slides are ready to go.
Perfect. Brilliant. Well, thank you all so much this afternoon for taking the time to learn a little bit more about multifamily. Thank you to the NewView team, of course, for having us. We greatly appreciate it. Today's presentation is about the state of the multifamily real estate market and Ballast Rock Real Estate specifically. Ballast Rock is a private equity firm that focuses on providing exclusive access to a number of diversified private asset funds, both in real estate, in private equity, and in venture capital. All of our funds provide superior risk-adjusted returns. Here at Ballast Rock, we emphasize performance, communication, and access to the management team. We currently have both a real estate fund and a venture capital fund open at this time for investments. And both of them, we regularly have investors coming through their New View Trust accounts and other SDIRA accounts. Today, I'll be giving a market update on workforce multifamily real estate specifically, which is our core specialty on the real estate side of the business here in the southeastern United States. As Brian mentioned, I do live here in Florida, though, as you can probably tell from my plummy English accent, I'm originally from London, but I've lived here and worked here in the US for more than 20 years. With that, my name is Tom Carroll, and I'm the founder and CEO of Ballast Rock. I spent the first 15 years of my career on Wall Street, 5 years at HSBC on Wall Street in New York as in interest rate trading and sales, and then just shy of 10 years at Goldman Sachs, where I ran structured credit trading for Goldman for Latin America. So why, might you ask, am I in real estate? Well, in 2016, I retired and was looking for what I believe to be the most attractive risk-adjusted return way to consistently deploy my capital, both generating income, being tax efficient about the way that I generated income, and creating capital appreciation as well. So in 2016, since 2016, I've been building Ballast Rock to do exactly that, help me deploy my own capital, my own retirement and earnings from there. So here at Ballast Rock, all of the decisions that we make are made through the lens of Wall Street trained professional risk managers. This afternoon, I'm going to briefly present about the macroeconomic backdrop, both in the economy more broadly and those factors most affecting the real estate markets. Armed with that background, we'll then discuss the specifics of the effect of market forces on workforce, multifamily, both nationally and in the Southeast, our defensive inflation-adjusted investment strategy coming into a recession, the operational value add that our best-in-class in-house property management team called Sunbelt Properties are delivering for our investors and residents every single day, our robust acquisition process, and our disciplined disposition strategy. My goal this afternoon is to clearly demonstrate the depth and breadth of thinking that we at Ballast Rock put into our real estate decisions on a daily basis, and why having an active, disciplined risk management team for your real estate investing is so critical for long-term, consistent success. So unless you've been hiding under a rock, you're likely well aware of the inflationary pressures on the US economy. Policy to stimulate the economy from COVID and concerns around COVID met with the supply side shocks of transportation complexities and markets and ports being shut down during COVID. Frankly, met with the Fed's the Fed's indecision and delays in making and correcting to combat a higher inflationary environment. All of that, the Fed, I think, really expected that inflation would be temporary and would work itself out, so they were late to make decisions. All of that led the US to having some of the highest inflation in any developed economy in the world. And all that was prior to Russia's invasion of Ukraine, which then, of course, immediately delivered additional supply side shocks and spikes in energy prices, further driving inflation. That inflationary growth has hit energy clearly, but has also hit the cost of shelter, housing, single family, multifamily, etc. as well, and has driven to some of the highest inflation rates that we've seen in recent history here in the US. So the Fed started raising rates as fairly late, right? Inflationary expectations were visible late last year, but the Fed expected that that would work itself out naturally and therefore was late to react. That delay in reaction has led to higher inflation than longer. And as a result, we didn't see the Fed act until March. The Fed has raised floating rates, has raised Fed funds target 5 times since the start of this hiking cycle, initially 50 basis points, and then growing to 75 basis points, along with telegraphing clearly that it is their intention to really get inflation under control. And a lot of their strength actually comes from their capacity to telegraph what their forward intentions are. The market's already pricing in another approximately 125 basis points worth of hikes through the remainder of this year, all of which is to slow the economy and get inflation under control. Why is this relevant when we talk about real estate? And this is a market update about real estate. Well, not only do some real estate borrowers borrow at the short end of the curve, at the floating, borrow floating rate, and we'll talk through some of that in a minute, but the majority of the industry is typically borrowing at the long end of the curve, i.e. benchmarked to, say, the 10-year treasury or some long-dated treasury bond. And the long end of the curve is driven by both demand and supply for that long end of the curve, but really effectively is a kind of average expectation of the market of where floating rates are going to be over that period of time. So in the case of the 10-year, it effectively represents sort of a market's expectation of where average floating rates will be during the lifetime of that bond. Obviously, there are clear demand and supply pressures that specifically drive pricing for that bond, but that is the way that I think big picture I think about long dated rates. And so with borrowers like us on the real estate side, borrowing primarily benchmarked to the 10-year bond, what happens in the 10 years is extremely relevant to the amount of liquidity that's out there in the market and the amount that is available to support acquisitions, and therefore has a significant drive in pricing. And as you've seen, we've seen a massive movement in 10-year rates. And that's driven our cost of borrowing. Equities, as I'm sure you're all aware, have had a significant sell-off this year. That is the case for most risky assets. So it isn't, equities being the one that we look at most frequently, but they are simply one risky asset class. And we have seen a large allocation away from risky asset classes, right? Your equities portfolio is down probably 20 to 30% if you're vaguely indexed to the NASDAQ or the S&P. And that really is the Fed trying to cool off the economy, reducing liquidity from the economy, and the market having becoming increasingly concerned about that economic impact, the true impact on Main Street, and as a result, allocating away from risky asset classes towards lower risk asset classes. So a better proxy for real estate companies' cost of borrowing is actually the BAA corporate bond index. We as a borrower don't borrow flat to floating rates. We don't borrow flat to Fed funds target or SOFR, which is the replacement for LIBOR, nor do we borrow flat to the 10-year treasury. We borrow at a spread over that, over those benchmarks. And the BAA corporate bond index is a better proxy for our broader cost of borrowing. And what this slide is showing is that there's been a significant movement in the cost of borrowing overlaid with what's been going on with multifamily cap rates. So multifamily cap rates until the middle of this year had continued to rally. So even though cost of borrowing, we'd already started to see a risky asset sell-off in equities, we'd seen debt moving, cost of borrowing going up sharply, we had not, as of the middle of this year, started to see a repricing of assets in real estate. Now, we're a few months later, and we are starting to see some of that happening. We are seeing a widening in capitalization rates in the multifamily sector, but it certainly has not been anywhere near as rapid as the widening that we've seen in the cost of borrowing and in other risky asset classes. So there's a few factors at play in why cap rates have not gapped wider along with the cost of borrowing in lockstep. One is that there's a delay. Real estate, from negotiation to diligence to closing, is a pretty long period of time. It can often be 60 to 90 days. And so there's in part just a delay to it. But the other component really is driven by the amount of dry powder and allocation that's been happening into real estate more broadly, particularly among institutional investors. So what we're showing here is specifically the amount of dry powder available. That means cash on the sidelines available to be deployed into multifamily and into real estate as a whole, and into multifamily specifically. So why is that happening? Well, multifamily performed very, very well through COVID. Here in the Southeast, in our portfolio, for example, we did not have a single month in which there was any meaningful change in delinquency or occupancy. At the same time, during COVID, inflation is our friend. We love inflation because, as we'll talk about later in this presentation, we are positively indexed to inflation. Unlike longer dated real estate, which has long dated leases, 20-year leases in office space or 10-year leases in certain types of commercial real estate, in multifamily, our leases are relatively short. They're 12 months and they're constantly rotating because we don't have them all mature on one date. They mature throughout the course of the year. Therefore, literally every single day we're adjusting rents. That means that we are, on the revenue side, highly inflation adjusted. And so after the strong performance of multifamily during COVID and the fact that we are an inflation adjusted hard brick and mortar asset, we've seen a large allocation from other risky asset classes like equities, like corporate debt, things like that, from large institutional investors into real estate more broadly, and specifically into multifamily real estate, especially over the last couple of years. This has been a broader based allocation, reallocation of assets. We've seen this happening for 10 plus years, but it's heated up in particular over the last couple of years. Specifically, what this graph on the right is showing is the amount of dry powder in billions that is sitting on the sidelines waiting to be deployed. And that dry powder has just been creeping up and up and up. Why is that relevant? And why is that relevant to the slide prior where we were talking about the movement in cost of debt versus the movement in capitalization rates? So capitalization rates being effectively the unlevered yield of a piece of real estate. So before we apply leverage, what's the unlevered yield of that real estate? Well, it's relevant because it's effectively a back bid, or what a trader would call a technical pressure on the market. So that means that as prices rise, there's so much liquidity looking to be deployed into this asset class that people just buy, right? So even though prices are rising, they're not rising anywhere near as fast as they should or would if there was not so much capital looking to be deployed into this asset class. That's dry powder. Unlike the Great Recession, i.e. the 2008 recession, this is not a real estate-led recession. This is an inflation-led recession that is being pushed by the Fed to cool economy and cool inflation. So first, it's our house view that this won't be a particularly strong recession. I don't think that many people on Main Street are even feeling it yet. They probably will in the first quarter next year as we start to see unemployment creep upwards. But for now, it's not really being felt yet by Main Street. Certain front-leading sectors like technology have started some layoffs, But more broadly, that's not happening yet. There's still a lot of wage growth, still very, very low unemployment. So it's not being felt yet by Main Street, but the Fed is trying to cool the economy, as we were discussing earlier. But this back bid from institutional capital in particular is what we're showing here in this pie chart is actually largely within the multifamily and residential sector, largely going into value add. That's the dark 50% that you're seeing here on the left. So it is, and on here on the right is, on the right is value add, on the left is opportunistic. But all of this is going into the multifamily sector, and there's a very strong back bid. So we're just not seeing a huge amount of price movement where other asset classes are declining significantly in price. Within real estate as a whole, we've seen, so not only are we seeing the sector receiving more and more capital, creating a larger and larger amount of dry powder on the sidelines waiting to be deployed, and waiting for those moments of pullback like we're having now to start deploying, but within real estate itself, over the last couple of years, we've seen a very sizable shift from other asset classes within real estate into multifamily. So what this graph on the left is showing is the volume of transactions in commercial real estate as a whole. That's the dark blue bar graph. And you can see that in 2021 and 2022 will be the same. The volume of transactions in commercial real estate is almost double what it was on average for the past 5 years. And it was more than double what it was in 2020 and 2019. Similar, so 2021, 2022, pretty similar so far. But so you're seeing twice the amount of transactions. And what the light blue dotted line shows is that 20 years ago, multifamily made up about 20 to 25%, give or take, of total transactions. During COVID, that number spiked up to the low 40s. In other words, people are allocating out of things like office space. I think that's fairly obvious why. Hospitality, again, didn't perform very well during COVID at the beginning, is performing much better now, but real estate investors are generally looking for pretty good consistency. They're looking for inflation adjustment, so on and so forth. So there's been this big reallocation within commercial real estate towards multifamily. So it's for those reasons that where we're seeing cap rate movement, we're seeing a lot less of it in multifamily specifically. There's effectively huge technical back bid, and within the industry, so there's allocation out of other asset classes into our asset class, and within our asset class, there's a reallocation into multifamily away from other sectors. So that's the technical conversation, i.e. what's going on in the market in terms of flows of liquidity. But then let's look at the fundamental conversation, which is that according to CoStar, the US needs another 4.3 multifamily units just to meet our domestic demographic growth. At the moment, and that's, by 2035, that's CoStar's estimate. At the moment, there has been significant underproduction of multifamily, and as a result, that has driven lower and lower vacancy levels broadly across the board. Sorry, just to clarify, that's 4.3 million. I think I said 4.3 units. I meant 4.3 million of additional units that are required by 2035. So I've used the word workforce multifamily. I've thrown that around fairly loosely without explaining what that means. What we're really talking about are people that have gross household income typically between about 35,000 and 75,000. And here in the Southeast, I would say it's more like 30,000 to 65,000. The Southeast in general has lower average wages than parts of the Northeast, for example, or the West Coast, though it has generally higher wage growth at that workforce housing level. So we're talking about, when we talk about workforce housing, we're talking about housing for police officers, firefighters, teachers, healthcare workers, retail clerks, a variety of different jobs, just regular hardworking people. Worth highlighting, when we talk about workforce housing, we are not talking about affordable government supported housing. That's really what you're looking at here. Oh, excuse me. What you're looking at here on the right-hand side in dark gray on this pie chart. That section is really affordable government supported housing in many cases. Workforce housing is attainable housing. Typically, we expect our residents to pay 30 to 35% of their income in rent. No more than that, or it starts to be choking. And these are market rate apartments, so that the rent is in no way set by the government. It is set by the landlord. We are targeting our assets specifically, our renters, very much in line with the broader workforce definition. And our rents are, again, targeting households with gross household income or average median income, AMI, of between 30,000 and 50,000 tends to be more our target audience. And our average rents tend to be between $750 a month up to, at the very peak, $1,450. But I would say our average rent is just around $1,000 a month. So let's talk about some of the trends that are impacting workforce housing supply. Well, interestingly enough, we never worry about new supply when we think about our asset acquisition. Why? Well, because we're buying assets at an average acquisition price, typically between $80,000 and $100,000 a unit. Some of the cheapest property to build from scratch in multifamily in the US, that would be, say, stick-built suburban garden-style apartments, typically at the moment is around $250,000 a unit. So in other words, to build it new, you're looking at about $250 a unit, and we're buying it for $80 to $100 a unit. That is effectively a different asset class, right? We're not worried about new supply coming into the market and choking off our demand. In fact, what we see in workforce housing is that you're seeing older properties that are removed from the housing supply. So you actually see a lot of demolition, which means that not only are we not worried about the supply increasing, we see supply constantly contracting, because as buildings are demolished, the new buildings that are built in that class A or luxury price point. They have to be at that price point. They have to be priced at $2,000, $2,500 a month in order to justify paying $250,000 a unit to build them. So we see general obsolescence. We see, as I said, site redevelopment into more luxury or class A communities. We see a lot of value add upgrading. We are a value add shop, but our focus is value add within the attainable price range. So we're looking to move average rents from $800 a month up to $1,200 a month, perhaps over a period of 3 to 5 years. But a lot of the value add that goes on out there is actually like trying to take an asset and turn it from a workforce asset into a luxury asset and take it out of the available supply of workforce housing. So that's that value add upgrading that really does reduce workforce supply. And then, a last or an interesting point to highlight is that actually a lot of the 2000 stock of housing was built to a quality that has not necessarily fallen down the quality spectrum to become workforce housing. Typically, workforce housing is not built. It is created from newer housing where either the neighborhood has changed or the property has kind of rolled down. It's an older property and it no longer can command luxury or class A rents. Well, a lot of the early 2000s property actually was built to a pretty good standard and therefore has been able to maintain that A or luxury price point, especially as we've come into tighter and tighter supply availability. So therefore, where typically you'd have a natural roll down the curve, which is what we saw in the 1960s assets, 1970s assets, 1980s assets, and even 1990s assets, when you started getting into the 2000s, the asset quality was high enough that it never really rolled down the curve in the same way. So all of these factors have meant that the amount of supply of workforce housing is contracting and contracting and contracting every day, all at the same time when we are, I think, all aware that that the amount of demand for workforce housing is actually increasing. An interesting, very visual way of demonstrating the lack of supply is in both workforce multi, but also in single family. So this graph here highlights single family home completion. And what you see is that after 2006, 2007, the amount of new homes that were being developed in the US, single family homes, dropped off significantly. A lot of developers went bankrupt. There was no liquidity available from banks to build. Issues that we remember from the Great Recession. Well, turns out that actual demand, supply outstripped demand pre-2008 for a couple of years, but it wasn't by much. And that demand hasn't stopped, but the supply dropped off substantially. And so what you see here is actually there's been massive underdevelopment of single family and multifamily housing for a very long time, for a sustained period of time. In fact, a 41% decrease in annual completions from 2007 to 2021 relative to the equivalent period prior to that. So that means there is a massive structural, fundamental dearth of housing, both in single family and in multifamily. The unaffordability of single family homes has also driven many would-be homeowners into renters. So since 2017, the Case-Shiller S&P Case-Shiller index, there's been a 50% price increase in the cost of housing. This is single family homes from 2017 to 2022. That is an incredibly large increase and has made single family housing unattainable for many people and driven those homeowners into multifamily renters. All of those factors, unaffordability, lack of supply, has and then we come into this high inflationary environment over the last couple of years, has driven to spectacular rent increases in multifamily over the past few years, like during 2021 and 2022 specifically. And in fact, we've seen 13.5% average rent growth during the last 12 months alone. So that is significantly outstripping the 8.2 to 8.5% CPI inflation, the headline inflation number that's been reported. So specific inflation to the cost of shelter has massively outstripped headline inflation. Now let's look specifically at our portfolio here at Ballast Rock in our Sunbelt funds. Over the last 9 months, we've seen our average rents grow by almost 10%. And on an annualized basis, that number will be very much in line with that 13.5% number that you saw for average national rent growth. But interestingly enough, on top of growing average rents, and let's be clear about how we achieve that growing average rents, a lot of that is achieved through renovation. So when we renovate a unit, we will likely when there's natural attrition, so somebody leaves a given apartment, maybe they need a larger apartment, they need a smaller apartment, that job has moved, whatever it may be, they leave naturally from that apartment. We use that as a moment to renovate. I need to highlight from the get-go, we do not step into a building and go through a mass eviction process. Some of our value add competitors do that. It is marginally more cost effective to do that, but it's just not the right way to do business. So the way that we do our value add process, the way that we do our renovations, is we start with all of the exterior work that we can do. We tackle issues of deferred maintenance. We tackle issues of any offline amenities. So, for example, swimming pools that might be offline, gymnasiums that might be offline, we bring them back online. We tackle any structural issues with a property, etc. And then we dive into interior renovations slowly and steadily over time, as there is natural attrition. And we typically are seeing about 15% attrition naturally, or turnover naturally, in our buildings every year. And we use that as the opportunity to renovate. So when we talk about these rent increases, just to be clear, this is primarily coming from renovated units where we may be raising rents to new renters coming in eyes wide open. We may be raising rents by as much as 30% on renovated units. On our classic units or unrenovated units, we're not raising rents at this rate. It's certainly not our business strategy to do that. It is really to focus on raising rents on renovated units and then smaller rent increases on classic units until there's natural attrition, and then use it as a moment to create renewal. To renovate and then raise rents more broadly that way. But you can see very sizable rent growth in our case, as I said, primarily driven by renovation, but still sizable rent growth in line with national averages here in the Southeast. Inflation doesn't affect everything equally. We've been talking about how on the revenue side, we've been seeing our revenue going up at more like 13.5%. Interestingly enough, inflation's impact on our operating expenses is not identical either. It differs by what subsector we're talking about. So interestingly enough, flooring, which ends up being pretty important in any of our renovations, flooring's gone up by about 15% in the last year. So that's quite a large increase, much higher than CPI headline. Major appliances, though, on the other hand, have only gone up by about 2 to 3% during the same period. Now, they're difficult to get your hands on, but the price themselves hasn't changed that much. So this is really talking about the differences. One key point has been that electricity and electricity service expenses have gone up substantially again this year in particular with Russia's invasion of the Ukraine. That is shouldn't come as a surprise to anybody that you've seen significant change there. We do, where we can, implement a direct pass-through of all energy costs for each individual property onto the resident themselves. So for their apartment, they will pay their own energy costs. So we don't see that naturally reflected as directly in our operating expenses as a whole, but naturally that does constrain other things and have an effect on the residents' overall capacity to make payments. Now, all of this is looking backwards, right? What inflation have we seen in the past on our revenue? What inflation have we seen on our operating expenses? Let's think a little bit about what the market is implying about future inflation. Well, how do we look at that? We look at the differential between TIPS, which are inflation-adjusted bonds, and nominal non-inflation adjusted US Treasuries, and we derive an implied inflation from that. Don't take these numbers as hard and fast. It's more a market's expectation of whether or not the Fed is actually going to get inflation under control. Earlier this year, I would say in the early summer of this year, the market definitely was not comfortable that the Fed had it under control, and that's why they were showing kind of 6% implied future inflation. However, I would say as of today, there is an expectation in the market in general that the Fed will get inflation under control. If you look at forward-looking indexes like PPI relative to CPI, which is backward-looking index, you will see that you are starting to see the effects of the Fed's actions on cooling the economy. And the market believes that that is happening. Now let's talk about the defensive positioning of within multifamily. You know, should you be investing in luxury apartments? Should you be investing in Class B, Class C, in ground up construction? Should you be thinking about value add or redevelopment? Well, first, as the New View team explained at the beginning, I'm not your financial advisor. I am specifically, have a fund that focuses on workforce multifamily. So obviously, I'm asked to talk about that rather than anything else. But there's a reason that I'm in this sector, which is that it is a particularly defensive sector. What we've seen historically through multiple recessions and through quarters of downturn for the last 20-something years is that Class A tends to have to offer more rent concessions in order to maintain occupancy than Class B and Class C, primarily because you'll often see Class A renters moving into Class B in an effort to reduce costs during a recessionary environment. As a result, there is just increasing demand during a recessionary environment for Class B and Class C. On top of that, there is no incremental supply, whereas there has been incremental supply, depending on the market. There may have been significant incremental supply in certain markets in that Class A sector, because that's all that could be built, right? You can't build workforce, you can only build luxury. So we believe that our portfolios are particularly defensive as we come into a recessionary environment. Now, in any other part of the world, 2 quarters of negative GDP growth would be called a recession. Here in the United States, that's not the case. The US has a slightly different definition of a recession. And so as of today, theoretically, we're not in one, but practically speaking, we've had 2 quarters of negative GDP growth. Anyone else would call it a recession. And certainly, I think even the US's definition will likely be triggered in the next quarter or the next couple of quarters. So when we think about defensive positioning for a recession, that's why. So I do want to highlight one of our core strengths, which is in-house property management. Sunbelt Properties is the exclusive in-house property management provider for Ballast Rock real estate funds. Today, we manage a staff of about 50 people across 5 states. But because we've gone full cycle on a number of assets, at peak, we had as many as 85 employees just within our operating division, Sunbelt Properties. For an employee and from an employee and resident's perspective, Sunbelt Properties operates like a third-party property management company, thus creating a level of separation between investors and residents, reducing risk and liability. However, during day-to-day operations, our team works directly with the Ballast Rock Asset Management team to make sure that all of our goals and business objectives are being achieved. And that starts from the very beginning with the Sunbelt Properties operating team being involved in due diligence. And then, of course, throughout the life of the value add process and ultimately the disposition of the assets. There are many unique differences between using an in-house property management company versus a third-party property management company, some of which you'll see on the next slide. Since we're not focused on growing our management company and securing outside clients, we're able to focus on what matters to us as a business, what matters to you as an investor, which is choosing the best team members, the best people, the best technology, the best practices that influence our residents and our processes and our business plans, and ultimately to achieve the best outcome for our investors. The benefits of using in-house property management really cannot be overstated. The level of transparency, accountability, and oversight cannot be achieved in any other way. We have no barriers to doing what's best for our investors or properties or residents. And importantly, our staff are empowered to do the job well every day. Sunbelt Properties runs like a separate company. It's run as a cost center. So if you ever want to have a conversation with me about investing in one of our funds, we'll walk you through our fee structure. It's very transparent and it's at the asset management level. The property management company is run as a cost center. And that means we're affected by changes of the market and changes related to COVID-19, just like anybody else. Here on this slide, we're highlighting some of the larger challenges we see most often running a large property management company. Things like turnover, staff retention, and an increase in the prices of labor and supply continue to be challenges for the property management business. To combat these challenges, we maintain a large focus on things like employee retention, recognition, and training programs. For example, our staff receive ongoing training through what we call our own Sunbelt University. Due to the large geographic distances between our staff, and we have assets across the Southeast, we also put extra focus on building connections with staff and local communities. Relationship management is a large part of what we do in property management. So you might be asking, why would I care about the kind of touchy-feely stuff? And the answer is pretty simple. We have a unique ability to provide a direct and positive social impact while also maximizing returns for our investors. It is our best, it's in our best interest and our investors' best interest to provide the best possible experience to our staff and to our residents. When we're happy, when they're happy, and when our staff are happy, we're able to create a virtuous cycle. And so the direct impact that we're able to have on our residents' lives reduces turnover and improves the quality of the buildings that we manage. So I do want to highlight a few examples of some of the extra steps that our operating team took during COVID-19. During COVID-19, there was widespread financial instability experienced by our residents, as by many. Sunbelt Properties proactively partnered with several state and local agencies to secure rental assistance. To date, we've received rental assistance from local agencies in 5 states that have directly paid the outstanding rent balances for our residents facing eviction. The funds received have been close to 500 grand since the pandemic began, and this continues even today. These funds have prevented countless evictions and throughout our portfolio while maintaining high occupancy levels. Another example of our direct impact comes from our staff being empowered to participate in local community and philanthropic activities. These include things like school supplies or school supply drives, getting involved in local civic organizations, and in some cases, and one case in particular, being awarded the best apartment complex in our city by the local newspaper. These things are important to me. They're important to our whole leadership team, and they're important to our residents and team members, and really emphasize the positive impact that we're able to have. I'd highlight this simply isn't possible investing in luxury apartments, right? You're not, the strength and skill of your operating team is equally important in every asset class within multifamily, but at the luxury level, you're just not able to have as much positive impact, right? The strength of your operating team really is determining the quality of the bagels that the yuppies that live in your buildings receive at the end of the afternoon. That's substantially less impactful than having a highly trained, skilled team interacting with your residents and delivering courteous, professional results for them every day, and then contributing to the community much more directly. So in terms of who we are, we focus at Ballast Rock on the Southeast. Our core mandate is North Carolina, South Carolina, and Georgia. We also have assets in Alabama, and we're focused on assets in Tennessee as well as in northern Florida. We have 2 offices at the moment, one in Charleston, one in Atlanta, Georgia. We have one of our key leadership team members that lives also in Chattanooga, Tennessee, and I live in Florida. So we really do have a pincer movement, if you will, over the entire Southeast. It's worth highlighting, as a firm, we do not invest on the coast. It's not because we don't like the coast. I lived in Charleston for 4 years. I love Charleston, and I love the coasts in the Southeast. But the reason that we don't invest on the coast, it's not the obvious thing of hurricane risk. It is the less obvious thing that the Southeast, the coastal Southeast, those economies are very highly food and beverage and hospitality driven. I love to eat at good restaurants. I love to stay in nice hotels, but for our residents, those are far more volatile industries for employment. So we like cities like Columbia, South Carolina, Fayetteville, North Carolina, Florence, South Carolina, Greenville, Spartanburg, Macon, Moultrie, Valdosta, Albany, Leesburg, Anniston, Birmingham. We like cities that have ideally strong core industrial base, but really it's about feds, meds, and eds, federal government or state government employment, higher education, 1 or 2 universities, they're very stable employers, and healthcare. That's another core issue. We love to have very sizable healthcare sectors in all of the cities that we work in. Generally, we find in all of our cities, healthcare is the #1 private employer in those cities. Why do we invest in the Sun Belt? You know, I worked and lived for 15 years in New York, love New York too. Why do we not just invest somewhere else in the country? Why are we so specific to the Southeast? Well, first and foremost, it's important that we're on the ground. We are. Our team, our corporate team are all on the ground in the Southeast. Our operating team are obviously also all on the ground in the Southeast. So it's important that you're on the ground. But fundamentally, we invest in the Southeast because we work in some of the fastest demographic growing states in the country. If you look at the top 10 net migration locations, net migration states in the US, we work in a lot of those states. So you can see that there on the bottom right. We are seeing net domestic migration out of the West Coast, California, out of places like Chicago, Illinois, and out of the Northeast. And we are the beneficiaries of that net migration. The Sun Belt is the beneficiary of those net migrations. Why? As I've said, historically, actually lower wages than those other locations, but faster growing wages, lower unemployment on average. So US unemployment's incredibly low right now in general, but it's even lower, it's even tighter in the Southeast. And that's always been the case for the last 10 years anyway. So lower unemployment, so more jobs, lower unemployment, generally lower taxes, generally perceived as more business-friendly environments. I can definitively tell you more landlord-friendly environments. That's absolutely a fact. So, you know, far easier to do business, especially as a landlord here in the Southeast than it would be in, say, New York. You know, this is part of a much broader demographic shift that's happening in the US and that we're the beneficiary of. So there is really those supply constraints that we were talking about, those are national supply constraints for workforce housing. It is even more extreme here in the Southeast. And we are seeing not just your general necessity for incremental demand, but a heightened incremental demand because of net migration. Now, all of these things naturally have led to the price per unit of workforce housing going up. There's no doubt about it. But they're not going up in isolation. Rents are going up too. So those incremental price hikes are reflected in higher rents as well. So cap rates have been coming down on average, though, for the last 10 years pretty consistently as prices have been going up. But as rents increases, it's able to support those price hikes. Specifically, though, it becomes more and more relevant to work with a firm that has the capacity to identify deals as you start seeing that price hike progression. Because as the moat, the difference, like the differential between the cost of new construction and the redevelopment of old properties, as that compresses, you need a better and better quality team in running that process of identifying what are the right deals to acquire. Here at Ballast Rock, we have a monster deal funnel. We look at hundreds and hundreds of deals every single year. This chart shows you two things. One, the size of that deal funnel, right? We looked at about 1,500 deals in the Southeast over the last few years. We've, at a high level, analyzed more than 800 deals. We've done detailed underwriting on nearly 600 deals. We've been on 150 plus site visits. We've been bidding on 75 assets, ultimately to whittle down to 17 acquisitions in the Southeast. So we really are looking for a needle in the haystack. Let me be clear, that does not mean that we're paying 2012 prices. I don't set where the market is. But what it does mean is that we're able to really find that opportunity for value-adding increase. Our focus is adding 150 basis points to 200 basis points of value-add NOI increase over the next 3 to 5 years. So we need to find assets that will enable us to do that. And that's what our massive deal funnel enables us to do. This actually talks about some of our recent discussions. And it highlights two things. First, it highlights that there generally is a pretty long time lag between either acquiring or selling a property and closing on that acquisition or closing on that sale. There's usually often a 3-month time lag. So we as asset managers need to start making decisions well in advance. So for example, when we saw the market start to turn late last year, we started to prepare our assets for sale. So we were acting to reduce risk for our investors well in advance of the Fed. The Fed didn't do anything till March. We were already making decisions back in November of last year to start reducing risk, specifically into what we thought was an overpriced market. So, for example, just to highlight, these are the 4 sales that we made in our last fund so far, Sunbelt Fund 1. The first was sold with a gross multiple on invested capital of 2.17 times. That's an 85% internal rate of return. The second asset, North Crossings, also in Fayetteville, North Carolina, 2.52 times multiple on invested capital. That is a 50% IRR. The third asset, Sycamore, also in Fayetteville, 3 times equity, 61% IRR. The fourth asset, College Park in Macon, Georgia, 2.3 times equity, 34% IRR. Past performance is no guarantee of future returns, but these returns are off the charts. And they're off the charts because of the talent in acquisitions, the talent in management, and the proactive nature of actively managing a portfolio, looking ahead in order to make decisions. That's what it takes to be effective as an asset manager in this sector. In this slide, we're talking a little bit about our disposition strategy for the remainder of our last fund, Sunbelt Fund 1. We're likely to go full cycle on this fund by the end of next year. We have 5 assets remaining in the fund, and we have a core strategy, clear strategy for disposition of each one of those assets. I wanted to quickly highlight an acquisition that we made 3 weeks ago, I guess now, called Windtree, also in Fayetteville, North Carolina. We exited 3 assets earlier this year. I was talking about it just a second ago. Heather Ridge, North Crossings, and Sycamore Apartments, all in Fayetteville. So we exited 100% out of the Fayetteville market. And a lot of investors asked us, wait, does that mean you don't like Fayetteville? No, we love Fayetteville. We crushed it in Fayetteville. But what's interesting is that we exited those 3 assets at approximately 3.5% cap rates. And then taking advantage of the market volatility over the last 6 months, we re-entered that same market with a new asset called Windtree that's newer, better quality. It's a B+ asset rather than B-, B-C asset. So better quality asset, newer asset, lower price per door, higher cap rate by about 200 basis points. So we entered in at a 5.37 cap day one with an expectation to push that cap rate up to about 7.5. That's what good active management looks like. Exiting a market, entering the same market, better asset at the right market moment and taking advantage of market timing. So we do have a final acquisition coming up in Sunbelt Fund 2, which does have a tiny bit of availability at the end of that fund. And that's an asset in Florence, South Carolina. With that, I'd like to turn it back over to the NewView team and move into Q&A. Thank you again for all of your time. I appreciate your patience as we walk through, and I look forward to your questions.
Awesome. Thank you so much, Tom. That was really great information. And I think you covered a lot of bases. It's going to be hard to ask any questions because there was so much good information in there. But we're going to open it up for Q&A. So anyone that's watching or listening, go ahead and type your questions in the chat, and I'll go ahead and read them off for you. Thanks for giving us a little bit of a heads up on some of the markets that you look at and why you like those markets. I think that helps clients when they're doing due diligence understand your marketing and type of markets that they should probably also be looking at when they're investing. So you did a great job with that. So I'm gonna go ahead and just give a couple quick announcements. Tom, if anybody wants to get a hold of you, what's the best way to reach you?
You can email me at Tom, T-O-M, at ballastrock.com, or you can email our investor relations team at ir@ballastrock.com. We have an online portal. You can go to ballastrock.com, click the login button in the top right-hand corner, and it will give you'll set up access to our investor portal. And within that investor portal, you should see any of our open funds. Right now, we are already starting to talk about Sunbelt Fund 3, which is a 100 million equity raise that we'll be doing during the course of 2023. We also have an open venture capital fund right now. We have one fund, one private equity offering an energy transition that may be interesting. All of these things are available to investors to use their SD IRAs. I would say probably about 25% of our 1,300 investors. So we have about 1,300 investors, all moderate, high net worth, or family office investors, all accredited investors. That's worth highlighting. Our investors do need to be accredited. And you can reach out to us and we'll explain what that means, or you can Google it. But of our 1,300 investors, they really, I'd say probably about 25% come through their SD IRAs or other form of trust or 401k account. So we're very used to working with groups like NewView and with investors in their SD IRAs.
Yeah, I love that. Self-directed IRAs. It's a great way to invest. It's easy, it's passive, it's retirement money, it's patient money. So people aren't having to tap into those checking and savings accounts. Tax deferred, tax free, depends just what type of vehicle that you want to use or you're eligible for. Solo 401k is definitely my favorite, exempt from the UDFI tax. So if you're eligible for that, you might want to look at that when you're investing into any type of syndications. Well, I don't see anyone bringing any questions in, so I'm just going to give some final announcements and we'll go ahead and wrap it up.
Brian, just quickly, I actually just had one of my colleagues who's on a chat. He was wondering how to ask a question. Could you tell the audience how to ask a question?
Yeah, on the right corner, there's a chat button. It should be right next to captions and graphics if you want to test it out. Or if they're on the social media, they would just type it in the social media and it would come up because we're live.
Okay, because it's apparently on YouTube, it does say that you need a channel to comment rather than.
And
apparently
sure.
it is.
Maggie would know more about that part than I will. And
okay, well, apologies. My colleague is saying that there doesn't seem to be that chat function available.
Oh yeah, we'll have to look into that and see why it's not working. But usually there's a function right there where they can type in the questions and it pops up right here in the Q&A. Huh.
Not to worry.
Because we've gotten last time we got questions to YouTube and they were coming in pretty easily. but we'll take a look at it. All right. So if you guys have questions on self-directed IRAs and how to get started on self-directed IRAs, then you want to email us at IRA specialists with an S, IRA specialists at newviewtrust.com. Just another announcement. We will be kicking off our workshop series specifically on the magic of multifamily. And that will start November 2nd through December 14th, where we have various multifamily experts come in, talk all about that market. It is a huge market out there in multifamily. And then we're going to wrap it up with a panel interview with everyone. That will be on December 14th. So we look forward to you registering. I would register in advance if you can do that. Tom, once again, thank you so much for taking the time out of your day to speak with our clients and prospects and viewers that want to learn more about alternative investing and to this alternative space. So if we get any additional questions that come in, I will definitely forward them your way.
Thank you so much. It was a pleasure. We appreciate it.
All right. Thanks.